with Frank Napolitano and Paul Rushforth. Here is Steve Gregory.
Not only is it March, not only is it a beautiful day again. All right, Paul, I will give you the floor to take your shot at Frank.
Well, Frank is stuck on the plane right now in Newark and obviously going to another conference. But
where would that be, I wonder?
Someplace warm, I'm sure.
Someplace warm for Frankie, yeah. But, you know, I was thinking about it. We're March, so we would have had about, 8 to 10 shows so far, 8 to 9 shows so far this year. What is Frank, about 1 or 2 he's been at?
Well, he's busy learning.
He's learning, yes, learning. Well,
and besides, we have Sheri. We don't need Frank.
That's right. She's smarter anyways and better looking.
Happy to be here.
She doesn't want to get involved in the chirps.
Yeah. Anything you'd like to say to Frank while he's listening on the tarmac?
No way. Go and have fun.
Hey, Wednesday, it's going to be the non-announcement.
Yeah, it's. I mean, I'll let Sheri comment more on this. This is her field, but I can't see rates going anywhere.
Nobody can.
No, and I mean, I don't think they're definitely going up or down. I think they just remain stagnant. Am I correct there, Sheri?
Yeah, that's what everybody's saying right now. The economists are pretty much in.
Just turn that towards you there.
Okay.
There we go.
Here I go, yes. Yeah, I know pretty
More
much
importantly is their comment afterwards, right? What they're going to say afterwards about the future?
Yeah, absolutely. And that's where you saw last week the Fed had made a comment saying that they're really, they're planning on going down, which I think was the first time they've said that they're planning to go to decrease.
Yeah.
So formally in those words.
But our GDP was up a little bit. Is that going to make another pause now?
Everything is just a balancing act, isn't it? Right.
Yeah.
So it's the jobs. It's if something goes up too much, it's all a balancing act. So right now everybody's thinking hold and probably not an increase or a decrease until maybe summer. So maybe a couple more holds and then in June they'd be looking at that.
Yeah, I think that's what Frank says too. He thinks June we're going to have a drop and we could have. I've heard different economists say different things. I mean, one that I really like is Benjamin Tall, obviously from he's what CIBC.
CIBC,
mm-hmm. and he came out. Now this was it's hard to predict, as Sheri said, with all the variables, but he came out and said he could see between 1% and 2% next year or this year, as a rate drop. That's bold. But would you agree, Sheri? I think we're going to at least have one.
One for sure. I mean, I remember so Ben Tal speaks at our conferences often, our industry conferences often, and a few years ago, I remember him going on and saying, "Listen, economists are always wrong.
It's true.
It's just how wrong we judge ourselves on how wrong we're going to be."
Yeah.
And so, there's so many variables out there, but definitely all of the markets would say when you look at the bond markets and the futures on those, it's all trending down and probably, depending on the month, it's looking 0.75 of a point, that kind of thing that usually from that.
It's funny when you talk, say, economists are, usually how wrong are they going to be? It is so true. You look at all these real estate predictions, and, you have anyone saying, prices are going to go down, prices are going to go up. Some say it's going to go up 7%, some say down 4%.
Yeah, all over the map.
All over the map. And the only thing you can do is, we have our pulse on the market. We know where we think the markets are going to go. And I think Canada as a whole, but especially Ottawa, I think we're going to have a very strong 2024. I think we're going to have a slow start to it. But then, as we see the rates drop in June, I think that's going to open the floodgates. We're already seeing it. I mean, we're seeing that listings are up, solds are up, average sale price is up. So days on market are down. Median days on market went from 40 to 20 by the end of January to February. So that's good news. So things are selling, which is great. We talked just before getting on multiple offers. We're definitely getting multiple offers again, but we're not seeing we are seeing lots of multiple offers with conditions. We're seeing some without conditions, but some are coming in with conditions. And we're not seeing the 100, 150, 200 over asking. We're seeing, the 5, 10, 15 over asking. So more of a market that we probably went through in 2018, 2019. We're more on pace with that.
Yeah, I think our days of extremes are done for a long time, right?
I think so. Yeah, I think so. I mean, extreme both ways, right?
Yeah,
I think the terrible market like we went through last year is I believe is over. And the crazy markets where we saw, in 3 years, we saw the average sale price go up 50%, which is, I don't think we'll see that in our lifetime again. I mean, that's
been a crazy few years, though. In 2022, they raised the benchmark 7 times and 3 times last year, like 10 times.
10 times.
In a row.
Yeah.
Like nobody saw that coming, not that fast.
Well, it's not even just the crazy market and what's going on. It's everything. Like, going through a pandemic, the weather patterns, what's going on in the world. Like the world's gone insane, if you ask me. It's totally gone
I think
insane.
the world's been insane for a long time.
It really has. We just noticed it now. Yeah. So,
but yeah, you've got to see people now. Are they chomping at the bit, at least looking to see if they qualify now? Are you getting more
There's
reaction?
a lot more optimism. We're getting lots more applications. Lots more people are putting in pre-approvals in anticipation of. I think it's more that people are feeling that they're settled, that it's not going up, that the rates aren't going up. I think it's all much like the stock market. It's there's a lot of investor psychology involved in it, and I think people have just decided to jump back in, and they're absolutely, our pre-approvals are going way up, lots of applications, lots of calls, that kind of thing. So that's, I think, bodes well. Also, in terms of the over asking and things, I think we're also, tell me if I'm wrong, but I think we're also getting away from, or we've all been away from the idea of people listing properties significantly under market to get those huge over market. So the listing prices are closer to what, I know it's not a science, it's the best that you can do, but I think the listings are closer in general to the price that they should be.
Yeah, 100%. It's a decent strategy if you have sort of like an uglier house or in a certain area. But yeah, that became a very lazy strategy during COVID when agents were listing homes for, 50, 70,000 under asking price. And, they were
getting 200 over.
Getting 200 over, which they were doing the job for the seller, but it was a very lazy strategy. There was a friend of the show, Mike Carasetto, sent us something today. I believe it was reported by CTV.
Oh, not the nude real estate agents?
No. The average home price. So homes for sale in the city that fall within the 500 to 750 range now make up the largest fraction of home valuations in the city. Homes in that price range make up 43%. So 43% of all homes are between 5 and 750. Only 19% of homes are valued less than 500.
And they would be condos, right?
Yeah, and homes 750 to $1 million now make up 23.6%. A decade ago, so not that long ago, the vast majority of homes, 79% were valued less than $500,000, and homes worth between $750 and $1 million only made up 3% of the market. So see how things have changed in a decade?
And where are we now, 750 to $1 million?
750 to $1 million, we're at 23.6%.
Wow.
So now, as we were going through COVID, I'm sure that number was way higher because $1 million didn't get you much going through COVID when the prices were absolutely insane.
Yeah.
So
you got to think, though, now here we are in March, and the average closing is what, 3 months? So by the time you get to 3 months, now we're in June. That's when the rates are supposed to come down. So if you're thinking about looking for a house, you might as well start planning right now, because by the time you close on a house, you'll have a better opportunity to, even if you take variable, rates should be down a little bit lower, and they may come down even more as the summer goes on.
100%. And I've been telling people now is the time to buy. And I know it's
actually the time to buy was 2018.
It was 2018, but I know it sounds like it's coming off slimy that I just want people to buy. But it's true, because we're going to see when the rates drop in June, we are going to see, I believe, a frenzy.
I think even before that, Paul,
I do.
I think we go another month and you get closer and closer, and like I said, those closing dates, then all of a sudden that the rate is going to be lower, and you're in more of a driver's seat.
Yeah.
And the 5-year may come down by then too, right?
The 5-year has been steadily coming down, of course. Or, well, I should say it's been following the bond market.
Week, though, right?
It's down this week. We're in the high 4s. We even have a lender at 4.89 on the fixed. So that's that's absolutely. It all speaks to buyer optimism.
Yeah.
And the more buyers who want to enter the market, what happens then? Then we get into multiples, and we get into so. I 100% agree. I'm saying the same thing to my clients when they call, that really you should be looking now.
And a lot of news articles are coming out about that. Lots of stories. Lots of TV reporting is coming out saying, there's a lot of pent up demand, and buyers are looking to get in now. Even though the rates are high, buyers are looking to get in now because they are coming down. Problem with that, I still hear so many bankers and mortgage brokers pumping that 5-year fixed, and I think that's just the wrong way to go.
Yeah.
Is a 5-year fixed right now until they start coming down a little bit. because we know variables definitely coming down.
So with all this interest climbing now, where are the listings going to be? Are we going to have the listings to fulfill the demand?
Well, we're way, way, way under listed. We don't have enough properties, that's for sure. We're over 3,000 listings right now, which is great, but we really need to be at 4,000, 5,000, 6,000 listings on the market. We just don't have the property, and we need to get, we've been talking about this for a while now, about builders building more homes and making it easier for builders to build homes, and it's just not happening. It's slow. I mean, I like to see that it's starting a little bit, but it's still way too slow. We need way more inventory than we have right now.
521-TALK, 521-8255. Got a special guest player, Paul, coming up?
We do. We have David Leith on the other end of the commercials. He's a partner with Farber, Robillard, and Leith.
In other words, he's a lawyer.
He's a lawyer, and he's a lawyer, and he's smart.
We'll be right back. You know, it's always nice to add to the brain forum here, especially when we get a brain.
That's right. We finally have a brain. Well, Frank's gone. So.
Hey.
Yeah. So welcome, David Leith. David is a partner with Farber, Robillard, Leith, and a lawyer extraordinaire and a very great guy and one of my go-to lawyers. So great guy. Welcome, David.
Thank you very much, Paul. Appreciate being on.
So, David, the reason I wanted you on today, because of what happened this week where, a client of mine has a mother living in the area, has a townhome, and she's about to move in with them, or I think it was moving in with them, and the kids want to keep the house. I mean, it's eventually going to go to them anyways, and they wanted to keep the house, turn it into a rental property. And I just wanted to see what your thoughts around that, what the best strategy is. Do they go on title, not on title? What do they do?
Perfect. Well, I appreciate that. It was actually a very good factual email that I did receive from you, Paul. And so when you have a situation like that where mom or dad owns a property, but they're getting elderly, they're either going to move in with them. I think in this case, they were moving into a nursing home. The son was looking to see, well, can we keep it? Is it possible to rent it? The bottom line, I think, is first and foremost is what's in the best interest of the parent, because this is their asset, their property, and if the son has power of attorney over the mom's affairs, he has a fiduciary obligation to the mom, to the parent, not the beneficiaries of the estate. And so they have to look and determine, what is this asset? What's the value of the asset? Does mom need this asset to pay for her care for the rest of her life? And so that's where you need to not only engage with yourself on the real estate side, maybe even the mortgage side, but also lawyer, accountant, just to look to see what impact is either selling the property and then keeping the money, renting the property. What does that do to mom's taxation situation, rental income, that type of thing? Who's going to be the property manager? All of those things have to be taken into consideration, I think, before you make that business decision to go one way or the other.
David, what's the tax like? So if I was to go, or let's use this scenario, if the son or the kids are to go on title of this property,
right?
When mom passes, they're going to have a capital gains issue there when they go to sell that, aren't they?
Correct. So if they add themselves to title and they want to say do that because they want to reduce probate, maybe make it simpler when mom does pass, a couple of things kick in. Number one, yes, you may be able to reduce probate, but now you've created a potential capital gain tax issue for the kid going on title. What happens if you're the son who lives in Ottawa, but you have a sister who lives in Edmonton? And then the mom puts you on title because you live here. What about the sister in Edmonton? The asset automatically will go to the son on survivorship when mom passes away. Now it becomes the son's. What happens if the will says, I want to give everything equally to my kids, but now you've just given probably the largest asset within her asset base to the son that he can sell, keep it himself if he wants all the money. So you got to be really, really careful with that. And yes, you will create a potential capital gains issue. You would want to speak to the accountant. Both the mom and the son want to speak to an accountant to see, number one, is this a prudent thing to do from a taxation perspective? are there any alternatives? Would putting the home in trust be an alternative from a taxation perspective? But that's more of an accounting question.
Yeah.
The other thing is, what happens if the son's 25 years old, never bought a property? Now you may be potentially impacting their first-time home buyer rights under land transfer tax, RSPs, a whole bunch of different things. So there's always that cause and effect. You want to maybe reduce probate, make it easy on the passing of mom, but now you've created a bunch of issues that you may not have thought about before.
Ooh, the more I think about this, the more I think cleaner is better.
Yeah. Well, it sounds like the cheaper alternative is to pay probate taxes rather than capital gains taxes. So not go
and then
on
who
title.
knows when they start and when they stop, and then what happens to her portion before.
Yeah. But I mean, the question of renting the property out while mom's alive in a nursing home, that's a different situation because, she's alive. This is her asset.
Yeah.
She may need the income from the home or the sale proceeds of the home in order to be able to maintain whatever expenses she may have on a go-forward basis, right?
Hey, David, more and more people are entering real estate now in non-traditional ways. They're either going rent-to-own or co-owning with a family member or friend. Any pitfalls you see there? Are you even seeing that now?
Right. So the rent-to-own, I'm not a big fan necessarily of those situations. They can be very complicated and can create, difficult, costly things if it goes sour. The second situation, you do see a lot of situations because the banks require, say, a little bit of extra oomph on the approval of the mortgage to add a parent on title. You're seeing a lot more situations where a mom or a dad or both have to go on title to the property. Typically in those situations, we're not putting the parent on fully as to an equal interest. Usually they're going on as a nominal interest just to be able to satisfy the bank's requirements. In those situations, it's the same thing. Parents on title, but they own a principal residence. There may be some taxation issues for them. It's minor, mind you, but it's still there. Then when you have a parent who passes away and is still on title to the home, then you've got some, it's got to be factored into potentially a probate application. So,
and how does when you do have a parent on title, how does that impact the first time the land transfer tax benefit for the first time home buyer?
Right. That's why. Yeah. Great question. We actually the reason you put them on as to 1% is because it's usually if the child is a first-time buyer, you want to maximize how much refund they're able to obtain from the government, and so by putting the parent only on as to 1%, the refund, which is a maximum of $4,000, gets reduced by something like $20. So it's very, very more cost-effective to do it that way.
Are you seeing friends getting together now, purchasing homes together?
I haven't seen that too much. Paul might be better to answer that, but that's not I think it was always around. You always had, people going to purchase homes more from an investment perspective, not necessarily from we want to get our feet in the market, so we have to go in with, I have to go in with a friend of mine, so we'll live together. I haven't seen that quite yet on the files that I'm dealing with.
One thing that you have to be cautious, you better have something drawn up if you're moving in with a friend.
That's what I was just going to ask.
I had a scenario where two of my very good friends wanted to buy an investment property together, and they didn't spend a little amount of money on this. It was a lot of money. And I told them, I said, guys, bad idea. It's a bad I love that you're getting into the investment game. I love you're doing that, but it's a bad idea. Well, guess what happened? A year later, one of the guys needed a little money for something, so he asked to sell the property, and the other guy didn't want to sell, but they had no choice. He couldn't afford it. They ended up selling and sold for a lot less than what they paid for it. Yeah. So
right. In those scenarios, you want to have exactly a joint ownership or co-tenancy, co-ownership type agreement. You don't want to go on title with your friend as a joint tenant because you do not want the right of survivorship to kick in. You want tenants in common, so you each control your share.
Yeah, can you explain that? That was a good one, the tenants in common and joint tenancy.
So joint tenancy, when you go on title with somebody else, and most spouses would do that, they go on title as joint tenancy because there's a right of survivorship. So when one of the joint tenants passes away, the asset can automatically go to the survivor. You register something called a survivorship application, and once registered, title gets transferred. When you go on title as a tenant in common, you each control your percentage interest in the property. So there's no survivorship rights. If you have a will, which you should, there should be something in there that deals with that, but notwithstanding, it kind of stays within your family line, whether you have a will or you don't. You do, if you're dealing with transferring that interest, you would have to go to probate and pay probate tax on the value of that asset.
You know, David, this has been awesome information. I really appreciate you coming on the show, and, I'll get you in for a team meeting like we talked about. How can people get a hold of you, David?
Great. Thank you very much for having me. I do appreciate it. They can contact me at my office at 613-722-9418, or they can email me at david@frl-law.com.
Hey, one more question Paul wanted me to ask you.
Oh, here we go.
Before we go, and I guess he was a little shy. He wanted to know how much he owes you for this.
Yeah. Where are you setting the bill?
No issues. Lunch on me.
Yeah, there we go. So once again, guy, David Leith. David is a partner at Farber, Robillard, Leith. So thanks again for coming on,
Thank you, David. Great information.
Thank you. Appreciate it.
521-TALK, 521-8255. We will be right back. Welcome back to the show. Well, here's a non-event that happened this week.
What do you mean? Which one?
The first-time homebuyer incentives discontinued. What? Did anybody even use this?
Very low take-up rate on it.
Why don't we let Sheri first explain the first-time homebuyer incentive, what that is.
And how bad it was.
And how bad and useless it was, and how everyone laughed at it. Now they're taken away, and we're like, oh, no, please don't take that away.
And no, I think it's more like, really?
Yeah.
Was it even there, really?
Yeah.
So it effectively was a second mortgage on the government contributed either 5% or 10% to, I guess the intent was to reduce payments for people. But they took the equity is what they did. So, there were a few issues with the system. One was no one really approved for it because the limits that they put on for maximum income and how that
they were like 120, 140 grand.
Yeah,
right?
and so you couldn't actually apply. You couldn't actually approve for any house that you wanted at that number anyway. So it really didn't apply. Most people didn't apply. In smaller markets, it might have. Here, it didn't. The other thing, as I was saying before, when I had clients inquire about it, I said effectively, so it's no interest rate, but the interest rate is actually whatever the growth is. So if I'm looking at a client saying, this isn't free money. This is whatever the cost of the growth of the property is. The government's going to share that with you. So it was also the cost of actually putting on a second mortgage and those kind of things. But in hindsight, those people who did participate, the few people who did participate in that program, if they were in 2018, the cost of that second mortgage was the cost of how much their home had grown for that 5% or 10%. So that cost of the second mortgage is probably 40% or more.
So they would be like homes went up 50%, say, in the last 5 years.
Yeah.
It would be 50% of the 10% the government
of the 10%, yeah. So on that portion, so if they sell the house, then they have to, on that portion, the government, gets the 5% growth of that. So
that's insane. Like, why would you give the government part of your home? Like, it didn't make sense. Like,
yeah, the best case scenario is you do use that program and hope values go down, but the odds of that happening are pretty slim.
And here's the problem. This came out in 2019. What happened in 2019?
Yeah, kaboom.
Kaboom. The market went crazy. So now it was 5% on resale homes, and they would lend you up to 10% on new homes.
On new homes.
Okay, so now I've just bought a new home, and I bought it for $500,000, and the government's giving me 10% of the down payment, and it went up 50%. The they're making bank on that, and I'm shocked that anyone took advantage of that program.
Because you wouldn't get near the equity you should out of that house.
No.
Again, hindsight, 2020, but it was, it like I said, so few people qualified for it in our market. Even before the market took off, it really wasn't a big seller anyway, so I don't think too many people are worse off as a result of it.
So let me ask you this. Now that this is gone, is there a glimmer of hope that they'll increase amortizations to replace it?
Anyone who, I think everyone, no one is committing to that at this point. I know we're working hard. We're
wouldn't that be great?
Lobbying hard.
You're taking away this for first-time home buyers. So here's what we're going to do. We've taken this away. We're going to increase the amortization to 30 years or even 35 to get into the market.
I suspect that the government's still sensitive about housing prices and doesn't want to increase, doesn't want to start another housing price boom. So I suspect that they're not going to buy into that anytime soon. Perhaps once we level out, they may they may listen to that.
Wouldn't that be a
logical
good idea?
argument.
Wouldn't that be a good idea?
Let me ask
though?
you a question here. When this came in, was this around election time potentially? Right?
Yeah.
Let's throw out some stupid promise.
But it was a bone that didn't. It just sounded like they were doing something where they actually weren't really doing anything at all.
It was a wasted program. We said it right off the start. I remember Frank and I talking about it on the air with you, Steve, when it first came out. And we're like, what is this program? And who is going to take advantage of this program? It's just a waste. But anyways.
Especially when you're tied to not knowing the future.
So guess what, guys? People are listening. This terrible program is gone, and I don't think anyone really cares.
Yeah.
Yep, agreed.
But will they replace it with something that has actually some substance?
Well, we are going into election, are we not? so we're going to have some stupid program.
Amortizations for 70 years. Here we go.
Yeah, exactly.
I think it's going to be anything that they introduce. I think it's going to be largely income based. I would be very surprised. I think they want to. I think the mandate going forward will be lower income people, but we'll see. We'll see what happens. So far, we're lobbying hard as associations in the industry, but nothing so far in terms of amortization. That's
what about leveling off the qualifying number where it's the same for variable as it would be for a fixed mortgage? Because if you want to get into a variable now, what do you have to qualify at? It's crazy.
So today it would be
8%?
8.2, somewhere in there. Yeah. So it's and people are all over the place right now in terms of, so I would say, so your comment earlier about 5-year fixed, Paul, I think it's really customer specific.
Yeah. Oh, for sure.
So that's where we, I think we need to kind of have a suitability for each client and what's important to them. But also sometimes we have to do a 5-year fixed only because it's the lowest rate and then they can qualify and squeeze in there. But
what about a 3-year as opposed to a 5?
The 3 years have been very, very popular. And what's happened over the last 8 months is there used to be a huge premium to go for the differential, the delta between the 3-year fixed and the 5-year fixed was significant, more than 100 basis points, 1%. Now we're really seeing a tightening of that. The 3 and the 5-year are off 20 points, something like that, 0.2. So it's making the 3-year look a lot more logical from that standpoint. So we're seeing kind of a combination of all those things. We have a lot of people who really like the variable because of the flexibility and that they think, they can kind of time the market a little bit better. Or some people like myself have been variable all the time, probably always going to be variable. Yeah. And that's because over time, historically, that's been the best bet.
Well, but people take a 5-year thinking it's safe. If something happens within that 5 years, especially now with rates as high as they are, and if they do come down over the next year or 2 years, and you have to get out of that property, it is going to cost you a fortune.
Absolutely. Yeah. In a declining rate environment, your penalty's going up, and that's kind of there's no ceiling or floor for that. So to understand what that could be, it's really, we don't know until we know how far interest rates go down. So the further out that you, in that 5-year, to your point, the further out that you book something, that's also going to increase a penalty if you need to get out of it. So those are considerations you definitely need to take into keep in mind.
Absolutely. And I know you say that every client's different, suitability and stuff like that. But, if you can get into a variable, especially when the rates are going down, it gives you a lot more options, right? Like you can lock in at any time, and then we know rates are coming down. We're at the highest we're going to be, and so why lock yourself into a 5-year fix unless you have to? But why lock yourself in a 5-year fix if you can get into a variable or a short-term mortgage?
Yeah, because your interest rate differential for sure over the next 4 years, right?
Well, you have to, pay now, pay later is also the question, right? So some people, when I'm talking to people in a variable, I'm saying, you're understanding that you're paying more now with the hopes that you're going to be paying less later, and you're going to be in a situation where you feel that you're in market later. Whereas with a fixed rate, I'm telling anybody who decides to take a 5-year fixed, you need to know that 3 years from now, the people around the water cooler are going to be talking about rates they got in the 3s, and you're going to be in the high 4s. Are you good with that?
Yeah.
And if they're good with that and they say, listen, I just want to know my payment. I've heard my friend, my whatever, their payments went up and I just can't handle the idea of that. This payment is good for me. I want to know I don't have to think about it for 5 years. Some people are still in that boat.
And how much of that decision is based on qualifying these days?
It depends. The differential between, when we're talking about high ratio, the differential between a 5-year fixed and a variable is 140 points. So that's a fair amount in terms of approval.
Yeah.
So could that make a difference? Yes. When I'm talking to clients about what's your preferred term, if I know they're close, I say I'll try and do it. I'll look at it in all ways and see if you qualify in each of these situations. So it's something to consider on approval for sure.
So what you're basically saying is we're a while away from them doing anything about the qualifying rate or amortization.
Yeah, I'm going to
You can leave now, Sheri.
I know, sorry. Yeah. We're still going to work. We're still going to try to get it, but I don't want anyone to hold their breath right now.
Hey, I learned a new word this morning.
Oh, Steve, did you learn the alphabet?
I did. Renoviction.
Renoviction. Oh, yeah, to renovate the property, to evict people.
The numbers are astounding how much they've gone up.
Well, the problem is, and I'm one of these people, I have tenants in some of my investment properties that are so under-rented, but nothing you can do about it. You can only increase it by, a small amount every single year. And it's so what people are doing, what landlords are doing is they're saying they want to do a major renovation on the house. They're kicking out the tenant, but Ontario.
So that's called an N13, okay?
So, okay, go ahead.
So they have gone up from 2021 to 2022, 545%.
Yeah. There's rules around that, though, Steve. There's rules around that. There's fines that, you can't just kick out a tenant in Ontario. You just can't. And the tenants have all the rights, and I'm dealing with lots of situations right now where landlords and tenants are just not getting along. And, realistically, the tenant has all the rights. I walked into one of my places a while back, and it was disgusting, absolutely disgusting. It horrified me. And I said to the girl, I said, listen, I work pretty hard to buy investment properties and to try grow some wealth and all that. And this is my house. It's my investment property. Treat it a little better, please. And her response was, I don't have to.
Wow.
Right? She doesn't. She doesn't. She's got all the rights. And it's, there's other provinces that are totally different. Like in Alberta, I mean, if I want to jack up the rent $200 a month, I can jack up the rent $200 a month, and if you don't like it, leave. So it's very, very different. I don't think either are right. I think there needs to be a happy medium where the tenant feels like they're playing by the rules and the landlord feels like they're playing by the rules. And listen, there's a lot of landlords out there that are doing some terrible things to get tenants out of the house, like renoviction.
Yeah.
And then there's a lot of tenants that are taking advantage of what's happening right now.
And we're hearing more and more of those stories, or at least reading about more and more of those stories. Tenants not paying, not wanting to leave.
Put it this way. What have I been saying for the last 18 years? Buy doors, buy doors, buy doors. I'll tell you what I'm saying right now. Sell doors, sell doors, sell doors.
Really?
Yeah. I'm contemplating getting rid of some of my doors just because
Just because of the headache? Or is that because you're older now and you just can't put up with
well,
it
that's
anymore?
it. That's it for sure.
521-TALK, 521-8255. We'll be right back. Welcome back. Sheri is here for Frank. Paul is here for Paul. Steve is here for Steve. And Connor's here for Connor. Hello, Connor.
Hi there. I have a question about credit scores and mortgages. So I found out this past week, unfortunately, I'm a likely victim of fraud. I pulled my credit bureau, and over the last 6 months, there was dozens of credit inquiries that I had never made. There were credit applications that I never made, and the worst, there was a credit card funded, maxed out, and then closed and not paid, all under my name.
Oh, boy.
Wow.
Oh, Connor, I'm sorry to hear that, man. That is now. There's something you can do about that, but
it's an uphill battle.
But it's an uphill battle.
So this is. I've done what I can do now. I've contacted the credit unions, filed the disputes, done all that stuff. Even the lender, the bank, who I have never even dealt with, who had this, put fraud alerts and everything. But my understanding is that this takes months and months and months to get resolved, usually. And what I want to know is if I apply for any kind of financing, heck, not even a mortgage, let's say I want to get a car loan, if they see my credit score went from 750 to 600 in 6 months. Sorry, daughter's with me.
That's okay.
Is this something that a bank will accept as an explanation, or are they going to say something like, you have to get this resolved, then come back and talk to us?
Well, you should really have. So, Connor, you've gone to the institutions involved. Have you gone to the Credit Bureau, Equifax, and TransUnion yet?
Yeah,
Okay.
I went to both of them. It's amazing how hard it is to speak to a human being.
Oh, no.
Yeah, exactly.
You're not kidding, for sure.
Yeah.
So you've put alerts on both of those, so no further transactions can be pulled from there without your. So they should contact you anytime any credit any credit inquiry is done going forward. They can usually provide you with something if you. So part of it is with them as well. But you should talk to them to see what their they can give a rundown for you to take to a future credit grantor. But
when would that number actually go back to where it should be?
It's hard to say.
Yeah,
it really is hard to say, and it depends on the. So they can remove it though, right? They can remove it as if it never hit your credit bureau. Not that they're not paying off the credit. They detach it from your actual credit bureau. So
but
you have to
do
some
need the proof first.
Yeah, and you need to do some declarations and some things like that to make sure. But they can detach it from your credit bureau, and once it's removed, then it's like it never happened.
And the worst part is, I know Connor, and I know the situation he's in. He needs some credit.
Yeah,
he's getting ready to pull the pin. So I mean, that's a shame, and I think that it will happen faster than you think, Connor. I mean, it's hard to say it's it's going to take 4 months, 5 months. I think it's going to take a lot less than that, to be honest with you.
What a pain, though.
As long as you've done all the steps that you said you've done, it should be quicker than you think. But it is a pain because everyone knows one thing I'm trying to teach my kids: credit is king.
Yeah.
You need credit for anything. So you've taken the right steps at least, and I just hope they can rectify it for you.
Thank you, Connor.
Can I say one more thing about this to the listeners? Don't wait until you need credit to check your credit bureau.
Yeah.
Fortunately, I had an intuition to go look, and I don't need money this exact second. So, but it's free to check your credit bureau, and don't wait, go do it.
Yeah.
Thanks, Connor.
Thanks, Connor.
good advice.
And you know what?
That's one thing I do. I check every month.
Yeah, and there's lots of free sites too. Like you can go to like borrowwell.com. There's all sorts of free sites that you can go, and it takes seconds to check what your credit's at. Yeah. And it's so worth doing because the situation Connor's in right now, it's a lot of work. Like it's a pain in the butt. I was about to say
some of those free ones are a little different than what the actual one is, and so I know different. So Equifax has a program you have to pay for it, but you get a little bit more accurate information. Accurate.
You also get 2 different credit scores.
You do get 2 different
Equifax.
and 2 different credit scores with Equifax. If you pull your Equifax, if I pull my Equifax, they're 2 different scores.
Really?
It's quite.
If you
bizarre.
pull mine, it would be different than if I pulled mine.
Yep.
How's that possible?
It's something.
It's the world we live in, Steve. It's the world we live in.
What I always hated about that is that anybody can put a ding on your credit, and you wouldn't even know it unless you check.
Yes, and I mean, you would have to have, so your bank, for instance, in the legalese that you sign when you open a bank account, for instance, you're giving them access to it. It's not anybody in the world can do this. It's if you have some kind of agreement on file at a bank.
No,
or
if you
at
miss a
credit
payment
facility.
is what I'm saying. If you miss a payment or you're late on a payment or something, that shows up. Boom. So you better know what's going on.
There's 2 different kinds. You can have a full credit bureau and a soft pull, and the soft pulls aren't the same as so when you walk into your bank, the teller may do something quickly to say, can I offer them some credit? That's typically a soft pull.
Right.
So that won't impact but the whole idea of inquiries impacting your credit score, it's very, very minimal. So
even for credit cards?
Yes, like I mean, there's kind of this perception that if you're credit seeking behavior isn't great, but the idea of having credit bureaus pulled doesn't impact your score the way public perception.
I can get that T-shirt at the hockey game now.
Yeah.
All right. Well, look, I don't know where the show went, but there it is gone.
It's done. Yeah.
Any birthdays, Sheri? Because I know you're here on Frank's behalf, so he must have spent the week sending them to you.
No, he didn't, but that's okay. So we have Isabel Anderson, who works with us with our sister company at Advanced Mortgage Corp. It's her birthday today, and personally, it's my very favorite sister-in-law's birthday tomorrow, Emma, and my very favorite mother-in-law's birthday next week, Jean Crease. So
Ooh,
happy birthday to both of them.
That's why you're here today, for the mother-in-law.
Me? No, I don't think we have any birthdays.
I don't think we got anything.
So. No. So Greg Tilley, my amazing photographer, videographer, has his big 5-0 tomorrow, and Greg's in the room with us. So happy birthday with Greg for tomorrow.
What are we doing for the big birthday there, Greg?
No big plans this year.
No? You want to give out your cell numbers?
I have one more. One of my neighbors, Eric Duffy, his birthday's on Tuesday. He's a third-year law student at Ottawa U, and he just got accepted to a summer apprenticeship as a lawyer at Soloway Wright for the summer. So he had a hell of a day, and so congratulations, Eric, and happy birthday.
Fantastic. Well, have a great week. Wednesday will be a non-event, right, Sheri?
Non-event.
Non-event. All right. The big event is next Saturday when we're back.
That's right. That's the big event.